The Headwater Resourceman here. It's February the 3rd, 2023. Very volatile day. Markets, well, they were very volatile, but I guess I don't actually really know what they ended up. I think they ended up quite a bit, I assume. So I don't follow that too closely. Gold went up to 970. I thought it hit even higher. Yeah, okay, 1975. And then it kinda cratered down $45. Silver, same thing. Was actually up to 24.65 and then cratered. It's like, I'm gonna keep saying this. It's like, I don't even try to guess where the metals are going. And I know before the Fed meeting yesterday, which everybody has, there's a million analysts out there watching that every day. Pretty much everybody on Twitter is watching that and waiting for that. And there's, I don't know how many podcasts that talk about what is the Fed gonna do? What is, it's just, to me, it's just unreal how many people focus on that stuff. It's like there's barely any competition because nobody actually puts in the time to research the actual companies or anything like that, or reading up on investing. Everybody, again, like people think that what's important is what everybody else thinks is important. So if everybody's talking about what the Fed is gonna do, that must mean it's important and I should start guessing what the Fed is gonna do. No. How on earth am I gonna have a better take on Fed than, I don't know, a million analysts that basically follow Fed every day and knows everything about rates and yield curves and yada yada yada. That doesn't play any part in what I do. Except for the fact, from a macro perspective, yes, we have a big debt problem, huge deficits, etc. So yes, I'm in gold and silver for macro reasons, and simply because history tends to repeat, and the debt problem is worse than ever. But other than that, I stopped researching gold and silver like, I don't know, 8 years ago, 8 years ago. I already made up my mind back then, like 2014, 15. This is unsustainable. I started buying silver at around $14 or whatever. At the time I didn't know anything about miners, but I was totally convinced, like, okay, this is gonna end. Mathematically, this is gonna end badly, and history has shown that it's gonna end with some kind of monetary debacle, let's say. So it's like, I didn't need to read up more on gold and silver. It's like, it's all in the numbers. The math doesn't add up. Human history shows that, sooner or later, gold and silver will revalue. And if everybody on planet Earth is on a fiat standard and everybody has a debt problem, obviously that's going to lead to some problems down the road. So that didn't take long. It's like, I remember buying silver. I didn't have almost any money back then, but I started buying second-hand coins. And when I was done with that, like, okay, if I'm pretty sure this is gonna happen, okay, what's the next? How do I get some leverage on that theme? It's like, okay, miners. I never had owned a miner before, etc. But I started reading up on that and started reading up a lot about investing, because investing I had been interested in for quite some time. But to make a long story short, time is on our side from a macro perspective. You see comics gold and silver is getting drained. Base metals are getting drained. Basically, commodities overall are getting drained. And still people, for some reason, think, yes, I'll rather put my money into cryptos, which at a time like this is like, if you, in my opinion, if you vote with your feet and buy crypto, which is, I guess one could say, artificial scarcity, if you can even call it scarcity, given that there's like 12,000 different coins or whatever. And sure, Bitcoin might be a bit different, or I mean, is different, but it's like, yeah, you could. Bitcoin is still just code. I mean, you could literally do recreate Bitcoin by default because it's been programmed. Anyway, it's like to pick that over commodities, especially let's say miners that are the future commodities, you know, juniors, when inventories are plummeting. It's like you need to go to risk reward school if you think it's a better bet to buy some crypto asset. I mean, basically they are trading sardines. Sure, some might have merit, yada yada, but nobody cares when it actually, I mean, they go up and down together. So it's like, in all intents and purposes, at least over the short to medium term, they're basically trading sardines. It's like I'd rather learn to invest, which I can take with me and get better at, incrementally better at for the rest of my life, than to bet everything on some crypto thing, hoping I'll get lucky once and you know, 10 bag my whatever, my portfolio or my net worth. It's like, yeah, you could 10 bag with a much higher degree of certainty in investing. It's just that it's gonna take some time. But as you get better, you're gonna have even better results. And it's like, it doesn't matter if crypto goes to zero within like 3 years, or most of them go to zero. If you learn to invest, you could. There's gonna be something to invest in for the, you know, as long as human civilization is around. So either way you slice it, it's like way better ROI to just become better at investing, and I don't see anything that has better risk reward overall than let's say miners' future commodity supply, because we are at the most interesting time ever, pretty much, or at least last several decades, I would think, in the commodity space. It's like Ross Beatty had a quote recently from a conference. He said, I'm paraphrasing here, but like, this is the most interesting time that I can remember, because pretty much every commodity is in a bull market. The commodities themselves, because as we've seen, it's like, yes, gold recently was $25 from $2,000 per ounce. But gold juniors are nowhere near their multi-year highs. And that's obviously why I think they're, you know, such no-brainers, because there's nobody believes they have any value, while they obviously have, and that goes for a bunch of juniors, because supply is going down. So by default, future supply goes up in value, but prices are not going up for the future supply, which means we're stealing more value by each passing year, because supply is getting worse and worse. Anyway, let's look at some tweets first. The rout in COMEX copper continued, reduction registered inventory Tuesday, blah blah. Okay, so this is copper. I mean, yeah, it's getting drained. COMEX silver, open interest divided by registered ounces, active months. I mean, you can see there's a red line here, March 23. It's like, yeah, okay, March 21 is here. That's, I guess, this one. You have March 22, that's the purple one here, and this second highest is December of last year, so basically the closest to the current one. I mean, there's obviously something changing here. It's like open interest. I think that's, I mean, I'm not an expert on this, but it's like how many that could want to take delivery or something, and divided by how much actual registered supply that could be delivered. So it's like, I mean, just look at let's say leverage here, where it's like, you know, potential interest versus actual supply that could be redeemable. I mean, this is a good sign, obviously, for silver. It's like, yeah, it's getting, you know, the inverted pyramid is shrinking. There's, you know, let's say demand is going up while supply is not catching up. So that's quite interesting, and it just goes to show. I mean, this is pretty much everywhere. Oh, and also it's like this is silver. Sure, this is 1 day old, but this is the hourly short. Why on earth would you want to trade this? I mean, I literally see, and you can see that as well. When silver's up, everybody's happy. Everybody's talking about the miners they want to buy. When silver's down, people whine. People talk about, I hate this sector, yada, yada, yada. Okay, what's the simple solution? Well, first of all, not caring about this at all, really. It's like a value investor. If you find a junior, hey, this is incredibly cheap based on what they have. It's not going to stop being cheap just because silver goes from 24 to 23 bucks. Maybe a silver junior, or a gold junior, is pricing in $1,500 gold and $15 silver. It's like the risk are to the upside. And of course, you could just make. The best way in this example is like just buy on down days in silver. For example, people's returns would get much better if they just, let's say, use that one rule. It's like, I'm never going to buy a junior on a day when metals are up. If you just did that, that would probably, I don't know how. First of all, you'd actually be buying cheap more often than not. So it's like, yeah, that probably is going to do wonders for your long-term results if you just employed that simple rule. I'm never buying a single mining share the day metals are up, just on red days. By default, you would be a dip buyer. Otherwise, like, good luck if you're influenced by the daily swings in the metals. Like, good luck making any money. So you'll be buying here, you'll panic sell here. You'll be buying here, panic sell here. Here you're gonna buy again. Then you're gonna panic sell here. So it's like, without silver really going anywhere, you're probably gonna lose money. While if you're only a value investor, it's like, let's say a company you own, it has, let's say this is the actual value line. And this is price. You would by default just buy more the lower it went. And this is a pretty good representation of the market. Like, let's say fair value is here, and then you have overshooting, undershooting, overshooting, undershooting. If you have some growth on that, so you have actually an increasing value trend, so it's gonna over and undershoot on all the way. But if you just kept on buying the cheapest things you could find, it's like, yeah, you'll do wonders. But it's just fascinating that almost nobody actually does that. It's like, how simple is not my investing strategy? I don't care about Fed, I don't care about rates, I don't care about where gold and silver is going on any given time, at any given time. I just focus on strictly what price I'm paying to buy all the assets of a company and what I think the assets are worth. And if it's undervalued by, let's say, 50%, meaning, okay, I have an expected return of at least 100% sometime, my only job is to buy and sit until that price to value gap is closed. I don't need to trade anything. I don't need to predict anything. If we go into a bear market, etc., there's just going to be even more things to buy, and I will have to value shuffle to the cheapest things I can find and sell some of my current holdings to buy something that's even cheaper. It's like I can't even have a cash position because by definition that's like, okay, if I have 30% cash, that means that there's nothing on this earth. Except for, again, I guess many use it for, risk management perspective. But it feels like a lot of people simply, hey, I think they could go lower, so I'm going to wait and buy. It's like, yeah, that's still, if there's something that is undervalued already with an expected return of 100%, you're basically saying, hey, I think my cash, which throws off, 1%, is better use for my money than buying something that's undervalued, and by default the risks are to the upside. That doesn't sit well with me. I can't do that. It's like, yeah, I'll have a cash position, at least a meaningful one, the day I can't find a single stock that I don't think is undervalued and have positive expected returns. But here, let's just look at the LME. It's like, this is nickel. A new 5-year low. From 350,000 tons of inventory on the LME down to less than 50,000 tons. I mean, if there was ever a time in the last 5 years you would want to, the value of future nickel supply would be high, that would be now. This would be the highest. Pretty much. How is that not convincing? And it's not just nickel. Again, it's like we can look at lead. I think copper is a bit. Okay, here's lead. Also, well, that is flatline. But it's like, this is even worse than nickel. There's like 20,000 tons from 130,000 tons 5 years ago. It's like, what do you think the value of lead in the ground is doing when you have supply, meaning a supply-demand imbalance, which, it's a pretty, sure, it spiked here for a while, but it's like the trend is pretty clear. And by definition, if this would continue forever, we would run out of lead. But that typically doesn't happen because price jumps up and, takes away some of the demand. So it's like, I think these are ticking time bombs. Pretty much all commodities. Here we have copper. That's at almost a new low here. And you look at the 5-year chart. Yeah, sure, it's, touched this level. But then I think it gets bailed out by either supplies coming online or prices going up or both. But it's pretty obvious downtrend here. Lower highs pretty much since 5 years. And it's like, yeah, this is lower low than here, same low, basically bounce. There's a reason why the major miners are panicking about copper and the governments are panicking about copper and nickel. We can basically steal copper and nickel in the ground for like ridiculously cheap prices. It's just unreal how much money we get, how much value we get for our money. And still, again, people would rather buy something artificial. They would rather buy crypto, where it's like, who knows what the value is? Might be zero. Typically, it's gonna be zero. But tangible assets in the ground of critical metals, there's a reason they're called critical metals. It's just unbelievable how anybody would want to buy crypto instead of actual tangible critical minerals, for example. Zinc, new low, new 5-year low. Peaked out here around, what's that, 300,000? Now it's down to, I don't know, what, 17,000? It's just absurd how low the inventories are. It's pretty remarkable. These are unsustainable trends. Something has to give. Either demand has to go down, maybe, global recession, or price has to go up that crushes demand, or supply has to go up. And if you probably are aware how hard it is to get the mine up and running today. There's no miners really to save the day. So if the global economy just keeps on growing at 2% per year, and we have the green revolution, EV revolution, Green New Deal, or whatever it's called, and infrastructure spending, yada yada. It's like, good luck not pushing up the prices of commodities. There's no big mines coming online. It's like, if we're gonna do zero carbon or whatever the goal is called. It's like, I think we would need 60 new nickel mines and I don't know what else. It's like a lot of stuff at least. And it's quite interesting. It's like lithium is hot. I mean, that's one of few commodity sectors that are hot. I mean, you actually see it's like juniors popping up all over the place, staked some ground where there's supposedly lithium potential, and they go up like 30, 40, 50%. That is a high sentiment environment. I have pretty much missed all lithium plays. I own a few, but those are not big positions. But it's like, yeah, it sucks to just look at, Patriot battery metals, etc. I think that went up like 30-fold in 1 year or something, or 2 years, whatever. Big returns, obviously, very large returns. But it's like, I don't know too much about lithium. And I'm not willing to, I have a big problem buying late in something I don't really understand, because if you even have to ask if it's in your circle of competence, you already answered the question. Lithium is not within my circle of competence, so I don't feel comfortable buying something, because by definition that's FOMO. I mean, yes, there are some lithium juniors out there or developers they have absurd economics at face value, and I think expected lithium demand, I looked at some chart, it said like 600% increased demand by 2030 or 40 or whatever. And I think nickel at 100%. Sure, obviously lithium in that chart or in that research paper has a lot higher increased demand going for it in the future. But at the same time, lithium is plentiful. There's lithium all over the place. It's not even rare. So sure, one could say, hey, I mean, 600% increased demand versus nickel at 100% demand. Yeah, but I would guess that it's like at least 600% easier to find a lithium mine than to find a nickel mine. So I kind of think they cancel themselves out. I mean, I do think, lithium is probably more than 600% more common than most metals we're talking about, especially if you're, any sort of economic quantity. So what's going to happen? I mean, there's, companies finding pretty, large lithium deposits all over, or finding lithium at least. So, and the question is, of course, then, will they be operational in time? Because sure, we might have all the lithium we need coming online, but that might be in 3 years or 4 or 5 years or longer than that. So it's not like lithium can't go up. It's just that with time, as always, if we have very high prices, everybody wants to develop it, and as we're seeing right now, money is absolutely rushing into lithium plays. We saw General Motors do a deal with some lithium company. So it's like, yeah, there's a lot of money going in to lithium, and there's and it's not even that rare. So it's like, yes, I think that the demand is going to take care of itself sooner or later. I absolutely don't know when, but I'm not, again, as comfortable with that, because I have no idea. Maybe, some say that sodium will be replacing lithium in some batteries, etc. Maybe there's going to be, a lot of lithium coming on, and yada. I simply don't know. I just know that lithium has absolutely skyrocketed, and a lot of money is going into lithium, and that lithium is not even that rare. So, in the long run, I could see some very big crashes, and sometimes very big rallies like we've seen. It's just not, I'm not too comfortable with it, but it's like, if you made money in lithium or, love lithium, I have no idea if you're, how the future is gonna be. So if you know lithium and, find something cheap, that's the most important thing. You don't have to be an absolute lithium bull, but if you find a cheap company and you understand it, and it's, focused on lithium, that's almost by definition a buy, regardless if maybe lithium prices are kind of stretched. Anyway, let's go into some news here. Okay, Eloro Resources drill hole DHK 27 intersects 202 grams per ton AG equivalent over 325 meters, including a high-grade portion of 396 grams per ton AG equivalent over 109.6 meters. I mean, almost 400 grams per ton AG equivalent over almost 110 meters. I mean, 3 meters of almost 400 grams per ton would be good. So this is obviously a monster hole. Yeah, I mean, they go through some other holes here. So it's like, that's the beauty of this. It's such a large system, and there's, sporadic, let's say, hits like here, 222, which is high grade for a bulk deposit, almost 54 meters. 80, I mean, that's not bad. That's around, 1 gram per ton over 141 meters. So it's like the metal content in this Iska system is just absurd. And the most interesting part, I would say, is, where do they have the... Here, it's like comparison of... They had a grade shell model in 2022 September. I mean, that's just, a few months ago. That's not even that long ago. The September 22 model had a, footprint, let's say. Strike of 700 meters, width of 650 meters, depth 810. Now, in January, just a few months later, they're up to 1,000 meters, 1 kilometer in strike, 800 meters in width, and 1.1 kilometers depth. So you can see the percentage returns. And of course, I mean, if you calculate the volume here, I mean, the tonnage is pretty absurd. And it's like, if you do some numbers on this, take 1,000 times 800 times 1.1 thousand, qubit, and you just, maybe 25 to 30% of that will actually be, economic, or like, that would probably be mined. And you have, let's put a 90 gram per ton AG equivalent grade on that. I mean, do the calculation. It's like, it's depending on what specific gravity you use, but I come up with a number that's like way above 1 billion ounces of AG equivalent. And I wasn't sure if the maiden resource was going to reach 1 billion ounces AG equivalent. Now I'm pretty sure it could be quite a bit higher than 1 billion ounces AG equivalent. That would put it at one of the largest deposits around already, from the maiden resource, the first version. And this is the new Casterita, etc. And they also had channel samples here. And you can see, I mean, this is basically where they have drilled it out so far at depth, high grade feeder zone. And they're workings down here. I mean, what is that scale? This is like, I don't know, what does that say? Is that 200 meters? Excuse me. So like, that's like 400, 500 meters perhaps. And they think there's they're going to be drilling soon for the porphyry depth, potential tin porphyry, which is expected to be closer to surface down in these parts, because this, you can see here, there's a, creek or a road, but this is quite high elevation up here. So that's like, I think it's like a kilometer drop or something. It's actually, I mean, it's basically that one could say, okay, down here you're like 1 kilometer at depth already, relative to the ore body than up here. So I think they will be able to at least drill these parts much better, etc. And I mean, it's just, and these are the channel samples. I just think it's a remarkable story. And I don't think the market has any clue really, because okay, maiden resource, and you can see this, which I think is kind of interesting. Here you have the September 2022 model. You can see there's like 2 legs down here. here you can see it's basically creeping in, eating up the theoretical target, let's say. And you can see, this magnetic inverse model. It's like, I don't know how big this is going to get, but it's pretty much wide open to the south, at least. I think it's open actually to the open here and open here towards these historic workings where they have mined silver, tin, zinc, and all of that, as well as here. And I think actually there's another tin prospect to the southwest. I'm not 100% sure, but I think that's the case. And they believe that there's might be a major tin porphyry below, and that this high grade zone just continues as well. So it's like, if the maiden resource might come out at 1 to 2 billion ounces of AG equivalent, again, that would be one of the largest deposits around. And if that has a grade of 90 grams per ton AG equivalent, that's high grade, especially for a deposit that size. And the metallurgy, as far as we know, the preliminary tests look good. So this is just remote. This is a project for a major. This could be a mine that could last for decades, pretty much. And sure, you have the Bolivia discount, etc. But even if you gave away 30% to Bolivia, this current valuation doesn't make any sense. And it also has tin, which is also a critical mineral, and lead and zinc, which we saw is like hitting new 5-year lows, and silver is also getting drained. I'm bullish on all those: silver, lead, zinc, tin. Eloro has all of that, and they have like 14 other projects on top of this, and this is still wide open. And I think the maiden resource will already show that this is one of the largest deposits that's been found in the last decade or so. To me, it's just incredible. And we know that Peter Marone from Yamana, the Yamana boss, is getting involved, put his reputation on the line, and publicly said that, hey, I'm bullish tin, I'm bullish Eloro. Eloro is the only company I'm a strategic advisor for, and he took 15% of the last financing. You don't do, coming off of a big win like that, you don't do that, willy-nilly, let's say. So it's like, do I think there's majors looking at Eloro? Yeah, I'm pretty sure, because everybody probably has seen that Peter Marone is in this, and I think he's in this for a very good reason. So I would expect Eloro to get bought out by a major company. And we've seen, maybe you missed this, but there are, I think, 6 or something Chinese companies that are now going to be getting into Bolivia for lithium. Okay, I think that's going to, increase confidence. Maybe a Chinese company would end up buying this or something. If they're already going to be there for lithium and have those connections, yeah, it would make sense, because this is a major deposit that is suitable for a major mining company. This would be, could be a flagship asset, basically. Yeah, anyway, huge, absolutely huge deposits, gonna get even larger. One of the largest deposits found in decades, I would think. District Metals announces a 3 million brokered private placement financing. I'm getting a piece of this. It was I didn't get my whole fill because there was quite a bit of interest. I like District Metals. It's in Sweden, so I have to like it. No, I'm just kidding. But Garrett Ainsworth, who's running the show, superb guy, had a huge success with Next Gen Energy, which was a uranium play. And as you might know, District Metals is acquiring, has applied, I don't know if they have gotten the license yet, of the Viken deposit, which is a monstrous, I think it's the second largest uranium deposit in the world, and it has vanadium, nickel, I think zinc, and some other stuff. It's like, yes, low grades, especially, per metal, But it's like, it's just an absolutely huge deposit, and it looks like Sweden is going to lift the moratorium, the ban on uranium mining, by March of this year. So I mean, it has a market cap after this. I guess it has a market cap of like 18 million Canadian. And I mean, I got into District Metals for their base metal project in the Bergslagen district. So it's like, yeah, I don't know what's gonna come out of this monstrous Viken deposit, but I wouldn't even, I would call it cheap just based on the base metal. So I see it as super high beta free option. A free optionality play, basically, on the second largest uranium deposit on Earth. Goliath Resources study confirms extensive porphyry feeder source at depth for gold, silver mineralizing fluids at the shorebed zone on Gold Digger property. Quinton comments here, it is great to see an explorer move a project like Gold Digger along with such unique diligence. Not only has Goliath met the challenge of systematically drilling the shorebed discovery over the past 2 seasons, but it is also concurrently advancing the other key aspects of the project, such as metallurgy and technical studies such as this. And the work that Dr. Thomas Monica, I mean, highly respected guy, he's also helping Escape Mining, for example, has recently advanced portrays a very clear genetic model that shorebed originated from magmatic derived fluids, perhaps from an as yet unidentified porphyry zone source. This bodes well for the discovery of even more extensive mineralization in the region around shorebed and at depth. And they go on to talk about, we are, this is CEO Roger, we are very excited with additional lines of hard evidence that show there's an extensive deep-seated feeder source directly related to the high-grade gold-silver mineralization seen at shorebed, and likely also the source of multiple new outcrops discovered along trend for over 8 kilometers and beyond on the Gold Digger property. One could make a possible analogy to GT Gold's initial discovery of their Saddle South deposit, a precious metal-rich vein system that eventually led them to discovery of their Saddle North deposit, a gold-rich copper porphyry. I mean, they've done a lot of work in a short amount of time, and so far you can see the mean results per drill hole, over 56 drill holes, 6.88 meters of 6.31, and one would think that not everything here, I mean, it has appreciable lead and zinc actually, and both is like, yeah, good grade silver, pretty good grade gold as well. Most is carried by gold. And if the metallurgy is very favorable, I think this could be a potentially very economic mine. I mean the big thing is that I think, at least, let's see if it's open. They know now where the higher grade zones are within the overall mineralized zone, let's say. So they're gonna be hitting the Gold Digger property hard this coming season, and they have a bunch of other targets. So I mean, it's kind of interesting that, okay, let's say there's a deep porphyry source. I mean, that big porphyry source probably didn't just mineralize this, because as they say, they are finding here up at Gold Swarm, a few kilometers away from the Gold Digger shorebed discovery, they're finding pretty much the same kind of mineralization. So I mean, there might have been one or I don't know more porphyries that spewed mineralization over a very large area, and this shorebed zone is just one block where it came in. I mean, this is believed to be the extension past this northeast fault, and as Quinton has said, the belief now is that this might actually be the feeder zone. So that opens up, well, a lot of potential, and it's open down dip and to the northwest in this picture. It's just, the more they drill, the bigger this is gonna get. That is my simple bet, and that's for the shorebed zone. And then if they make some other discoveries, I mean, who knows how many deposits we might end up having here if they just get around to drill it, for example. Timberline Resources confirms new gold-silver target at Eureka. this part of the Carlin district, or the Nevada, this part of Nevada in the Eureka district is getting pretty hot in terms of CRD type mineralization, because you've seen Paycore as well as I-80 hit very good, very nice grades over sometimes very thick widths as well. It's like very impressive mineralization. So they've done, you know, some work on that as well. It's like, oh, okay, it seems there's a lot of CRD potential here. You can read this news release yourself, but it's like, yeah, if you look at the Timberline's land package, I mean, they have a bigger land package in that area than I-80, and have a bigger land package than Paycore as well. They have the southern extension on strike from both of those companies. So I think there's a good potential, and of course this would be a bonus basically, because they're finding Carlin mineralization in terms of gold already. But if there's CRD potential as well, that's nothing to sneeze at, let's say. So yeah, this is the I-80 Gold Ruby Hill mine. This is where I think they're drilling the CRD system. I think Paycore is in this area. I'm not sure, but you can obviously see that. I mean, Timberline has a very large land package, and we know it's, we know it has gold already. And these are apparently patented claims even. So that's one, and this is again, I would think, okay, this is the fad shaft. This might be where Paycore is hitting as well. So I mean, it's pretty much directly on strike, patented claims, and they're finding silver values up to 750 meters. That smells like, I mean, obviously there's something produced these high silver grades. So I don't know what's going to come of this, but I think by definition, given we know what they're drilling here and here, and now what they're finding here, this has, some value, that's for sure. This has potential, has some value. I mean, it's not the largest claim block, but you can see I-80 Ruby Hill mine. I mean, you could fit like 3 of those in here, and it's again on trend, I would say. I mean, and obviously the best pathfinder is simply, if you find gold and silver, there's obviously gold and silver there. So there's high grade gold and high grade silver here. So this, from a closeology perspective, I mean, it's pretty much right nearby where the hot zone is for CRD here. I don't know what they're gonna do with this, if they're gonna drill it or whatever, but this is very much going up in value, just this patented claim block here. And that's on top of what they are drilling down here, which is mainly Carlin gold. So I mean, like Quinton said, he believes the Eureka district is very much underexplored, and both Paycore, Timberline, and I-80 is showing that's the case, because these might, I mean, the CRD they're finding up here, these two companies, that would be possibly a company maker for any junior, and that's just from the CRD. So very, very, very encouraging for Timberline shareholders, especially since, I mean, it's not like a lot of this is priced in. And sure, of course, I don't know how easy it will be to find actually CRD, but I mean, I think they could quite easily do a deal if they don't want to drill it themselves, because we've seen what happens if they do hit some CRD. Headwater Gold announces 2.28 million private placement. This is this is quite exciting. I'm going to try to participate in this financing as well. This is one of few early stage explorers I really, really like, simply because they have such a great team. Management got a lot of skin in the game. They have Newcrest as partners on 4 projects, and they have I think over 10, maybe 11 projects at least in total. So they basically have 6-7 projects that they own 100% in, and now they're doing a race, because Newcrest is obviously just going to fund the exploration at the joint ventured projects. So that's taken care of. I mean, they're footing the bill. But after this race, Headwater can also do work on their wholly owned projects. So there's going to be a lot of irons in the fire. Okay, the Newcrest properties for joint venture projects, 4 in total, they're going to see more drilling, and they've already hit some good stuff at, what was that, Spring Peak, I think. Yeah, I mean, you can't bet against a team that gets, stakes 11 projects, let's say, and have Newcrest interested in 4 of them. I mean, that kind of should tell you a lot about how good these guys are. I think it's remarkable. It's like they get 10, 11 kicks at the can. Sure, in the joint venture projects, if it ends really well, they would retain 25% of any of those 4 Newcrest joint venture projects. Still, 25% of something that Newcrest would want is probably going to be worth a lot. So those would be considered to be company makers if that ends up being the case. And maybe they find something that is not up to par with Newcrest, but still would be, let's say a mine. But at the same time, they're after 500 to 1.5 million ounces, let's say, of high-grade epithermal gold and silver mineralization, which could be low tonnage, very high margin in the boiling zones, high grades. Most of these kind of deposits have already been mined. They might have a few that are have yet to be mined, obviously. Because never forget, there's 1 million ounce deposits that are worth more than a 4 million ounce deposit. It simply comes down to the economics. So if you find high grades, high margin mine or high margin deposit, if that's just 1 million ounces, that might be worth several 100 million. So yeah, again, it's I think this is, I love the shotgun approach, because you're so de-risked to the upside. And again, it's if things go well at any of the 4 Newcrest projects, Newcrest is going to pretty much fund, I don't remember how much they will fund, but it's they could do a lot of work. I think the total deal is for up to 142 million US, which is over 200 million Canadian. Which theoretically Newcrest would spend without Headwater paying a dime, and they actually get, I think, 10% operating an operating fee or something. So yeah, love that one. Nevada King intercepts high grade oxide gold at Atlanta, including 2.8 grams per ton over 67.1 meters, 2.95 grams per ton over 51 meters, and 3.43 grams per ton over 33 meters, 0.5 meters. This is becoming quite the story. High grade gold and silver. Recent news release showed that they've tested some core for silver, and they're getting, and you can see that here actually, I think. Yeah, this is the AG. It's 125 over 33 meters. And there are some, sporadic hits. I mean, from the let's say from the silver alone here, it's 80 grams per ton over 45.7, depending on metallurgy. That could be very much workable. From an open pit scenario, but the bulk of the value is gonna come from gold. I'm pretty sure about that. Target area here, you see where this is wide open, not a single drill hole. Here's wide open. Well, I mean the theorized target is pretty much wide open, and you have these arrows here pointing to where it's still open. And it's somebody commented on Twitter today. It's he believes they have 1.5 to 2 million ounces of, let's say, average 1.5 grams per ton AU oxide in Nevada. this could be worth. I mean, there was some mine. What was that? Round Mountain. I don't remember what the mine was called, but that was around 2 million ounces of pretty good high grade oxide gold. I mean, high grade to be for an oxide deposit, but because as we know, there are open pit oxide deposits in Nevada which have a average grade of like 0.4. So you can just imagine, assuming stuff like metallurgy or strip ratio, etc., it's not terrible, and I don't think that to be the case. If you can make money on like 0.5 grams per ton of oxide gold in Nevada, what do you imagine what 1.5 grams per ton could do in terms of cash flow. So I think Nevada King is cheap. I think it's going to grow. I think it's becoming a pretty unique story in Nevada, and they also have on top of this, they have the third largest land package in Nevada, largest of any junior. They have a ton of other projects, which would be, I mean, if you're not paying full price for what the Atlanta gold mine, which is what you see here, is likely going to be, you're by definition not paying a cent for the other, I don't know how many hectares it is, but it's like, yeah, it's a very large land package. So it's like, nobody can tell me Nevada King is not cheap. I think it is, one of the cheapest gold units that I know of, and it's like, that is, really, I mean, if they only had the Atlanta gold mine, I think it would be a value play. But if you have also an enormous land package, that is a lot of value you pay absolutely nothing for if you're not even paying full price for this. So this is in my HODL portfolio, which is the same for most other companies I've discussed. And lastly, just want to touch on Magna Mining. If some might remember, I did a video, I think it was last week, about Magna, and I was just going over the Magna case from a, let's say, game theory perspective. And my conclusion, I haven't changed anything in this chart. The price was at this level, actually. Yeah, I think it was on maybe, might have been 30th of January. And I showed, like, when I tossed and turned about the case, it's like, okay, short term, because like I said, everybody's focused on these the private placement that has already become free trading now. I don't know that everybody has received their shares to their brokerage account. It's like, I don't know if everybody could sell, immediately. There might be, let's say, a staggered approach in terms of locking up, getting shares. So if you want to sell, some might have not even received their shares, so they haven't been able to sell yet. So I could see, a volatile period. But the key thing about, that I highlighted was that it doesn't make sense from a game theory perspective, because all we can do at any point in time is do the most rational thing while not knowing what the future will bring, for sure. It's all about risk reward and possible scenarios, etc. So, given that Magna Mining is so cheap that just to catch, get a average peer valuation, something like that, it would need to reprice, I think, 3 to maybe 4 times higher. So that's basically the chronic risk to the upside until further notice. That just based on what they have, for it to be fairly priced relative to peer average, it would need to, let's say, for simplicity, let's say 2 to 3 times. That's a chronic risk to the upside of 100 to 200%, let's say. That is absolutely nothing to sneeze at. You don't find that typically, because sure, there are PA staged companies which are trading at a fraction, let's say, of the net present value, but they're like, first of all, it's a PA, and then they're, there might be a capex to build a dam mine of like 400 million, and with inflation going up, that's probably going up every year. And they might not even have permits for X amount of years and yada yada. So it's like, when you think about it, if you calculate the resources Magna has across 2 permitted projects in Sudbury, Canada, which is absolutely a tier 1 jurisdiction and location, it amounts to somewhere along the lines of 8 million ounces AU equivalent. So think about this. Do you think you could find a gold junior in, let's say, the heart of Nevada or Canada, whatever, Sudbury, with 8 million ounces on the books, split between high grade open pit, high grade for an open pit, and high grade underground ounces, permitted? They could be self-funded after going into toll mill production, so you wouldn't even need necessarily 300-400 million in capex to actually get into production even. There is no way a gold junior with those characteristics would trade at an enterprise value of, like, I don't know what Magna is right now, let's say 190 million Canadian. There is absolutely no way. In a time where it's like nickel is deemed to be a critical metal, and they might even get a grant, and there's like a lot of exploration potential left. So with knowing that, my conclusion in the last video was like, if I sell here because I think there's a risk of a short-term dip, what I'm saying in that case is that, hey, these 183% of let's say very probable returns, that is not enough for me. I'm gonna gamble, sell those shares, give that probable return to someone else, and hope I might get even better returns. That is basically the same as, the I wouldn't say old saying, but it's like, hey, I'm not gonna pick up this $500 bill, because there might be a, if there was even a bill like that, like a $700 bill down the line or down the road. No, if you do that, it's like it wasn't easy. I gotta admit, because like I've said a bunch of times, the biggest fear people have is that something might go down in the short term. That is all everybody's focused on. That's why people sell here. Why people sell here, why people basically sell here, why they sold here, etc. But if you just skip the crap, skip the short-term crap, only focus, what am I paying, what is this worth, where is the magnet, where is this going to gravitate to over time? Again, we don't know when it's going to revalue to fair value. Honestly, it should, if this market was rational, it should have gone like this. Day after the resource announcement, it should have gone like this. It should have gone from 43 cents, well, actually it should have gone from like 35 cents straight to like $3. Pretty much. If this market was such, a rational pricing. It isn't, obviously. That's why, even if you're right, it takes time. But if you know where you're probably heading, again, Is it a big deal if you think, hey, this is the point of gravity? It's going to gravitate to at least $3 per share, and at that point, we're not even at Jason's, like he said, the CEO, which I think has a huge skin in the game. I wouldn't be surprised if he at least has like 70% of his net worth in Magna stock. He said, I won't sell a share until we're at 1 billion market cap. So one could say, okay, that is the point of gravity, because he's going to do everything he can, obviously, to reach that. And that kind of says something about what he thinks the assets are worth that Magna has in the hands of such a management team, obviously. He's like, yeah, 1 billion, that that's gonna be, you know, quite easy, let's say, because it's pretty goddamn impressive when you think about it. Like, I mean, anybody that has like 10% of the net worth in a junior would be like sweating bullets typically. And you have a CEO like that who's probably riding, you know, pretty much one stock or something. And he's saying, yeah, I'm gonna, you know, I'm not taking profits even before that. It's just I mean, I think it's kind of incredible actually. But again, point I'm trying to make is, if you have a sense of what the I mean, again, it's like, just to, if it goes to 3, it would be pretty much in line with peer average. We don't even need, that's based on what they have. So we don't even need exploration success for this to gravitate to that place. So that's the beauty of it, when you find a growth case that is already cheap and has margin of safety. So this is like the chronic upside risk, at least like $3 per share, let's say. You know, Jason would obviously say it's higher than that, but just, you know, for starters, I mean, that's a pretty good. I mean, we're at what, 135? I mean, that's really good just to get the peer average. And the best part, it's way above peers. Magna is more advanced than any of its peers. So again, it's like, if I sold here, I would be giving away the opportunity to someone else. I would be parting with my participation in this story, because I hoped somebody would actually be dumb enough to sell it lower, and there weren't enough smart investors to pick up all those shares. And I think I mentioned that as well. It's like, I know I'm gonna feel pretty goddamn stupid if I sold, let's say, I don't think I sold a share. I actually added here, I think. So I think I'm at all-time high share count. Yeah, I'm pretty sure I'm at all-time high share count. Anyway, I would feel pretty stupid. Like, yeah, I'm gonna sell now. Sell the best risk-reward case I know. So I'm selling that, and I don't even get a dip. You just effed up the best opportunity ever because you were so greedy that, let's say, the best risk-reward profile in the junior space that I know of wasn't even enough. I mean, think about that. That's like in poker, if you could, like, yeah, I got aces on my hand, but I'm gonna throw away that because I'm gonna try to, well, okay, that was a highly theoretical, but let's say you pick up kings and you throw away kings because there's a chance you might get aces. So basically, in that case, nothing except aces is something you would play. And you would obviously not make any money in the long term, because I don't know what the chance is exactly to get aces, but you would you wouldn't play almost any hand. I mean, think about it. It's like that is I mean, from a game theory perspective, this makes total sense. If you're a trader, sure, but it's like, in my opinion, the whole point of value investing or a case like this is that the risks are so considerably to the upside. So selling by definition then becomes dumb. And we have no idea when this is going to revalue. And like I said last time, I could see a scenario where a bunch of people have already sold, because again, nobody, if there's short-term downside risk, I'm sure as hell I'm not gonna want to be in this stock. So they sell. Even maybe they even know that's like, yeah, this is one of the best cases around. It's like, yeah, got everything, like skin in the game, the assets, the jurisdiction, the metals, the management team, skin in the game, all of that. So like they're willingly selling their ownership of, let's say, the best one of the best juniors around that is also dirt cheap, because it's going to go lower, so I'm going to buy back, because they understand that, like, yeah, this is for sure junior I would like to hold over the next 2 years, because I think it's already cheap. It's going to go up in value, but I'm going to sell out now because I want to get in even cheaper. So that's obviously irrationally greedy by definition. But anyway, so okay, so you have people who sell out. You might have some people who shorted it because they also thought that there was going to be a bunch of dumb people who took profits here just because they're up, and basically disregard the fact that, hey, like Dundee, who actually doubled down instead. So even, I mean, Dundee is like, okay, they're getting in at I don't remember what it was, like 27 cents. So their position from a, value standpoint or dollar standpoint is up like 300-400%. So their exposure is up 300-400%, and they didn't even take profits. They even added to it. So they might be riding 600% with 600% more exposure to Magna than here. That is, I mean, when you think about it, I mean, at face value, it's like, yeah, I'm 600% more bullish. I mean, that doesn't, really add up, let's say. But it's like, that what it's, by definition, what it says or means at least. So the fear I had was that maybe there's, people are not that dumb that they're actually willing to take considerable profits here, like Dundee, because they actually added. But we have people that sold, maybe some who shorted, and if they're short and don't have a private placement shares, they must cover in the market. If people sold with hopes of buying in later at lower, they're gambling, so they would need to buy back. And then you have the possibility that there's not really going to be any selling. So what I, theorized was that if the market is smarter than I give it credit for, meaning that we won't have a shot at getting in at 70 to 80% cents, which I would almost go all in at that point. That's how ridiculous that valuation would be, in my opinion. We could see FOMO, because it's so obvious that Magna is cheap, and when let's say the realization comes that, hey, I'm not going to get the chance to get in even cheaper, or at least materially cheaper. So if I want to be a part of this let's say journey to 1 billion market cap, let's say, I better get in again. So I don't know if that was the case today, and again, I don't know what's going to happen tomorrow or next week. Maybe I could see it getting volatile, but there's also a chronic risk of more assays and stuff like that. And I don't, like I've said before, it's like the beauty of a cheap play like Magna is that if Magna would find no more nickel, copper or PGMs, this should still revalue to $3 at least. So we're not even taking risk, because there's no exploration holes that could take away the resource, unless the infill drilled and they came out with nothing. But the infill drilling they have done so far has produced some of the best holes in the entire space. So if anything, it looks like it's actually better perhaps than the resource suggests. So it's just, basically there's a chronic upside risk to like $3 per share at least, I would say. And then you have the exploration and producer premium potential and grant potential, etc. So it's like this is such an asymmetrical trade. It's like what are the risks to the downside? It's like what can go wrong? Things can go wrong, but it's like they have the best team. They're permanent. Could we see delays with production? Sure. But is the nickel copper going anywhere? No, it's not. Which they've already drilled up. And that's worth somewhere around $3 per share at least. So it's just crazy. And you get also, in that case, you get, with taking no valuation risk, you get all the upside potential from an exploration, etc. So this is as good of a bet as you can find, I think, in when it comes to investing. And in this space at least. It's just incredible, and that's why I basically it's like forced myself. It's like, don't be a dumb, greedy person who's gonna start to try to trade the biggest no-brainer I've seen in 7 years. And so far, hey, it looks good, but that was not the point. It could have gone down. That market could have been that stupid. But it's theory comes first, because in the end we can only do at any point in time what makes the most sense from a theory perspective. And if our theory is sound, that's going to show up in a long-term results. So I hope I will make the same decision all over again if I find more cases, on par with Magna. Well, basically, I mean, any cheap case is, by definition, it's dumb to sell, even though it's like, yeah, there's a risk to downside. It's like, yeah, but kind of like, who cares? If you know it has, let's say, well, from this, let's say it has right now chronic upside risk of 130%. So we're thinking that is just a matter of when, not if. That's more than double your money. So that is the chronic upside risk. By definition, there is no downside risk, because this is where we have our base case for fair value. Then it's just a degree, okay, what Mr. Market does on every day. Maybe it goes down a bit and you get hit 154. Maybe it goes up, so you get reward, and then there's like 95% left, etc., etc. But by definition, selling just becomes stupid unless you find a case that has a combination of higher probability and or a combination of higher, returns, times probability. Like, okay, 50%, probability of a 200% return is equal to 100% probability of 100% return. But unless you find something that is cheaper with higher probable returns, let's say, it's by definition the dumbest thing you can do is sell. Because it doesn't matter. I mean, from that perspective, it doesn't matter where Magna goes in the short term, tomorrow, whatever. Because in our base case, we're gonna end up here. And that's the long game. And sure, you could take Jason's price target as like, yeah, I'm not going to sell either we will hit 1 billion or we will not hit 1 billion. There are only two options there. So it's like, yeah, I mean, it would be pretty cool. Like, yeah, okay, I'm going to take profit when Jason takes profit, let's say. And let's say nothing happens. Let's say he doesn't need any money, yada, yada. And we reach 1 billion. And maybe he doesn't even take profits. We don't know that. But it's like, one could say, like, okay, if the CEO says 1 billion is his target price, I'm going to stick with 1 billion. In that case, obviously, by definition, we would say that as long as you can find a better case, it's a buy and hold. And if it retracts from that or goes lower, it's just an even bigger buy. Yeah, anyway, it's like I didn't know that we were going to go up today or etc. But it's like, from a game theory perspective and risk reward perspective and investing perspective, I think that was the absolute most rational thing to do. But almost nobody will agree with that. I still saw, on Twitter today, people like, yeah, is it time to get in? It's like, is it time to get in? Or will there be more shares coming loose? Again, that's just, I mean, if you're even asking that, you don't get the case first of all, because it's just mind-numbing. It's like somebody came up to you and it's like, hey, I'm offering you a Rolls Royce or whatever, which costs like, I don't know, I have no idea what it costs, but let's say 1 million. You can buy this for 300,000 from me. No, I'm not going to buy that. I think somebody might sell one for 270,000. It's like, it doesn't matter if somebody sells it later at 270,000. You still bought a $1 million car for 300,000. So it was a good deal. And if somebody sells it for 270,000, you know, which is even cheaper, obviously you would want to buy that as well. So I mean, that's how I look at, you know, value plays. It's like the only time a cheap stock, the only time you should curse if a very cheap stock got cheaper is if you have absolutely no way of taking advantage of the opportunity. I have bought here. If this just went straight up to 3, I would make less money than I will do now if I hold it to 3, because I was able to buy even more at a lower price than here. So it's all a matter of perspective. But still, people always complain about short-term corrections because they have no idea what they're doing. And that's why almost nobody makes any kind of money in any market. They don't beat an index because they have no idea what an opportunity is. They see all the corrections as a curse because they have no idea where the stocks are probably going to go. But if somebody guaranteed you, let's say somebody said, Magna is going to hit $3 within 6 months. What would you do in a correction? Would you curse at the market if let's say you knew it was going to hit $3? Here it sold for 144 or 149. And you know, hey, within six months, this is going to be a double. It's like absurd returns for 6 months. 100% in 6 months. It's like if you could compound like that, I mean, you would be rich as hell, obviously. And a correction comes. I mean, you would be counting your lucky stars. You would be selling old books or whatever and just piling even more because you're going to make even more money. That's how you should look at corrections, in my opinion. That's the only way that makes sense. That's why corrections are both a blessing and a curse, depending on who you ask. You know, I was close to. I've actually, you know, I was hoping, and I actually raised some money, or was prepared to raise some money at least, if we got a dip. But I couldn't touch my current holding because, again, it made no sense from a game theory perspective. But, and now obviously I wished I had, you know, bought even more, let's say. But anyways, like my you know, minimum price target for Magna is like $3 at least. So I think there's a high likelihood that we will see $3 per share in Magna, and probably within 6 months. That is a very, 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 very good return. And if it's probable, it's a very, very, very good case. I can say that for most juniors I own. That I, you know, pretty, you know, high probability that they were gonna at least double without anything other happening. I mean, sure, any company could make a discovery or something like that, and then they could go up. I mean, that's the whole point of why this is, in my opinion, such great risk reward. Because typically you have to take exploration risk to have a multi-bagger, let's say, or even 100%. Typically, or at least sentiment needs to swing. I don't need any help from, I don't even think nickel sector sentiment needs to get better. I don't even think sentiment in the sector really needs to go up a lot. I just think that the more people who start to read up and become aware of Magna will realize how cheap it is. So I think that, again, there's a chronic upside risk here to at least $3. And that's without any exploration success. So I don't see us needing any catalyst for it to go up over 100%. Which is unlike most companies. Because let's face it, I mean, some of the gold and silver juniors I own, the bet is that if they reach a resource that Magna already has, then they might go up 2-3 times. Magna already has it and has an enterprise value which might be okay, double some of the other companies, but it might take 2 years to reach Magna. So again, the more I compare Magna with any other junior, I only typically get even more bullish on Magna. It's like I've compared Magna to the rest of my top 10, let's say, and I don't think they're even close. I don't really think they're even close, simply because how de-risked Magna is. That's why I still have by far the largest position in Magna. Okay, that was a long rant. I hope some of the stuff I said made sense, and hopefully you can apply it with success over your hopefully long investing career. Consider me biased. I own shares of all companies mentioned. They are, I think everyone is a banner sponsor as well. So consider me biased. Do your own due diligence. Don't treat this as investing advice, and I don't share your profits or your losses, and know what you're doing. Again, have a plan, because Mr. Market has absolutely no plan. It has no idea what it's doing on any given day. We have to have common sense and patience, and that's really all you need to beat this market, and actually handedly. It's just that almost nobody has both. Okay, thanks for listening. Bye.